Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. Charlie Munger, Warren Buffett's right-hand man, is regarded as one of the industry's legends in investing. Since 1986, he has outperformed the market by nearly 2,000%. Munger recently addressed the critical problems in the economy and financial markets at the Daily Journal's annual conference. In this video, we'll discuss how Munger is planning his portfolio to outperform the market in the next few years. So without further ado, let's get into it. First, we must examine the macroeconomic situation in order to fully understand Munger's strategy for making big chunks of money from the economy. Because of COVID-19, the federal government was forced to intervene to help as customer spending came to a halt. Unemployment can be divided into two categories. U3 unemployment keeps track of all unemployed people looking for work. U6 unemployment is a more comprehensive metric that includes discouraged workers and part-time workers. U3 unemployment exceeded 14% in April 2020, while U6 unemployment exceeded 22%. This is a significant number, given that nearly 1 in every 4 persons was unemployed or underemployed. So Congress issued stimulus checks to citizens and supported state and local governments with various financing facilities and grants. These checks also benefit businesses by providing COVID relief funds. And for monetary, the Federal Reserve cut interest rates, making borrowing less expensive. The target interest rate dropped from 1.5% at the end of February 2020 to 0.06% in April 2020. That rate is currently 0.08%, but everyone expects it to rise. These measures are setting the ground for a severe economic collapse. While the Fed cut interest rates, it increased market-based treasury bond purchases or quantitative easing. During the epidemic, the Federal Reserve acquired more than $4 trillion in debt, effectively pumping money into the economy. M2 is a measure of the money that covers cash on hand, savings accounts, money market accounts, and certificates of deposits under $100,000. Inflation was finally influenced by the law of supply and demand. The availability of more money to everyone increased the demand for commodities, but this alone did not cause the current inflation. Munger is well aware of the rise in M2 money, inflation, and the subsequent repercussions, an asset bubble. Problems with the supply chain have also exacerbated the situation. Have you observed that there are fewer things in stores and the prices of numerous items such as consumer electronics have increased? The difficulty to get goods off the boats and into the marketplace account for the majority of this. The basic problems existed before COVID, but the pandemic worsened them. There really were a lot of problems. But before anything else, I'd like to explain first that the ship offloading capacity is restricted and there aren't enough chassis to expand it. Due to a lack of salary increases, the number of truckers authorized to work at the ports has decreased. The situation was aggravated by the fact that U.S. warehouse technology lags behind that of China, Japan, and Korea. Moreover, warehouse worker pay has not always kept up with inflation, and hiring good warehouse workers has become more difficult. Supply chains have also been affected by a labor shortage at warehouses. A skilled truck driver, Ryan Johnson, posted a viral article detailing some of the challenges from his perspective. He compares the present supply shortage beverages to a Costco or Walmart, with only one cashier serving hundreds of customers. Truckers like him have to wait for hours in 3 different lines before picking up a container to transport across the country. Goldman Sachs and other investment firms monitor the supply chain. Goldman recently deduced the stress level to a 9 out of 10, with 10 being the maximum level of stress. The number of vessels waiting to unload commodities at the Los Angeles port dropped to 89 from a peak of over 100, according to the Marine Exchange of Southern California and Goldman Sachs. When you consider that there were no vessels 20 months ago, this is a substantial number that may sound frightening to some, but there may be a ray of hope. When this economic issue is likely to be resolved varies, although it appears to be closer to the end of 2022 to mid-2023. The main point here is that all of this pressure leads to a shortage of goods. Consumer prices have reached new highs as a result of this pressure and the increase in the money supply. The Consumer Price Index recently increased to a 7.5% annual increase. Inflation and interest rates are interconnected, which is a vital concept that we should understand. Inflation reached unprecedented highs in the 1980s. To stay ahead of inflation, Fed Chairman Paul Volcker hiked rates several times. While the outcome was positive for the economy in general, rising interest rates is not a politically acceptable option. Even though the Fed is meant to be outside of the control of politicians, Charlie Munger believes it's improbable that someone like Paul Volcker will be able to raise rates in the current political situation. He also stated that this could lead to new problems that are worse than in the late 1970s and 1980s. The late 1970s and early 80s were bad years to invest in the stock market, as I have mentioned multiple times in some of our videos. When adjusted for inflation, the market returned 0% from 1965 to 1980. Munger predicts a similar scenario, with the market perhaps returning negative returns over the following decade.
There's never been anything quite like what we're doing now, and we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so.
The first outcome we discussed was a decade of high inflation and low inflation adjusted stock market returns. There's also the possibility of a second conclusion, which Munger is considerably more concerned about. The Fed has previously declared that it will raise interest rates in order to stop the repetition of what happened in the 1970s. CME Group, the world's largest futures exchange, just released a report that examines market expectations and how well investors estimate rate hikes. In 2022, 4 to 6 Fed rate hikes are expected, followed by 2 to 3 more in 2023. These increases are usually 25 basis points each. 0.01% is 1 basis point. A 25 basis point increase is a 0.25% raise, so a 25 basis point increase from 2% would result in a rate of 2.5%. The target interest rate is expected to wind up at 1.625%, up from 0.08%. The Federal Reserve is cutting asset purchases, primarily treasury bonds, often known as treasuries, in addition to raising interest rates. This action affects reducing the amount of money accessible. The Fed decreased purchases to $60 billion in January 2022, down $30 billion from December and $60 billion from November. It's worth noting that the Fed continues to buy bonds, thus increasing the quantity of money in the economy and making artificial demand for treasuries. As the Fed reduces its purchases to keep price and yield levels, there would have to be an equal amount of new demand. This increased demand would have to compensate for the Fed's lack of bond purchases. To have a net zero impact on the market, treasuries would have to find outside investors willing to add $60 billion to $100 billion to their portfolios each month, and that's quite impossible. So the tapering will result in bond prices dropping. Bond yields and bond prices are inversely connected. Therefore, greater U.S. Treasury yields would happen. While the media concentrates on the Fed raising interest rates, bond tapering will have a significant impact on bond yields and also on interest rates. Charlie Munger is hesitant to predict that the low-rate asset bubble would burst when interest rates rise. He feels the lower rates were implemented as a last resort during the COVID outbreak. The United States is doing something that may cause serious trouble, and the longer we keep low rates and rising inflation, the worse it will get, especially now that we've passed COVID and must live with it.
Conventional economic theory argues that excessive monetary and fiscal stimulus over the last 2 years has triggered the highest inflation in 40 years. Do you broadly agree with this thesis? And more importantly, do you think there will be a high economic price to pay as the Fed attempts to bring inflation back under control? I guess the reasons for it.
Well, The first part, I agree with it. We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. I think we also know that some of our earlier fears were overblown.
What should investors do now that we know the economy is in serious trouble? Munger is bearish on office real estate, but he advocates investing in apartment building stocks.
The Mungers have Berkshire stock, Costco stock, Chinese stock, Sulilu, a little bit of Daily Journal stock, and a bunch of apartment houses. Do I think that's perfect? No. Do I think it's okay? Yes. I think the great lesson from the Mungers is you don't need all this damn diversification. That's plenty of it. You're lucky if you've got 4 good assets. I think the finance professors and that sell the idea that perfect diversification is professional investment. If you're trying to do better than average, you're lucky if you have 4 things to buy. And to ask for 20 is really asking for egg in your beer. It's very few people can have enough brains to get 20 good investments.
Munger believes that diversification beyond 4 to 6 investments is not a smart idea, contrary to most financial professional advice in business classes. Though he doesn't provide an exact figure, he claims that too much diversification leads to diminishing profits. Markowitz's modern portfolio theory, or MMT in short, lies at the heart of this argument. According to this hypothesis, adding a stock to a portfolio lowers portfolio volatility. The swings become fewer and less as you add additional stocks. However, this trade-off has not always been one-to-one, as each additional investment reduces the portfolio's value. Of course, this is based on the assumption that each investment is proportionally equal to others. Having 10 stocks would mean each stock represents 10% of the portfolio. With 5 stocks, each stock is worth 20%, and with 100 stocks, each stock is worth 1%. One stock doubling would have a small impact with 100 stocks, whereas one stock doubling would have a considerably higher impact with only 5 stocks. According to Munger, the current market is perfect for betting and prediction. He used the SPAC space as an example, which raises money before having investments.
Well, certainly the great short squeeze in GameStop was wretched excess. Certainly the Bitcoin thing is wretched excess. I would argue that venture capital is throwing too much money too fast and there's a considerable wretched excess in venture capital and other forms of private equity. And so we have a stock market which some people use like a gambling parlor. And the transactions of the people who love the gambling parlor aspect of the business and those who want to make long-term investments to take care of their old age and so forth. I mean, you muddle it in one market, and it goes out of control because the stock market becomes an ideal gambling parlor activity. I don't think that ought to have been allowed either. If I were the dictator of the world, I would have some kind of a tax on short-term gains that made the stock market very much less liquid and drove out this marriage of gambling parlor and legitimate capital development of the country. It's not a good marriage, and I think we need a divorce.
Munger also mentions the great short squeeze and excessive multiple valuations in addition to the 850 SPACs. According to Bloomberg Estimates consensus earnings, the S&P 500 is currently trading at 20 times forward P/E. While this is down from a recent high of 27 times in August 2021, it is the frothiest it has been in 20 years. Likewise, the Nasdaq has dropped to a Bloomberg consensus P/E of 28 times, down from a high of 40 times in December. These levels have not been seen since 2003. Given the current macroeconomic conditions, diversification outside of the United States could be beneficial. Munger has made investments in China through companies like BYD and Alibaba. BYD has consistently been one of Munger's greatest investments, leading to his most recent investments in Alibaba. So in this year's and last year's interviews, he explained why he chose to invest in China despite the significant dangers. There are numerous hazards associated with investing in China, as many of you are aware from recent news reports. While there are risks such as governmental, economic, and delisting issues, Charlie Munger feels that the value in China's financial sector is significantly better when compared to the United States.
Well, we did it for a very simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China.
Munger went on to say that there are bad tensions between China and the United States, and that they will continue to exist since the United States has not appeared to realize that the variations in government are acceptable. While China's administration and policies would have failed in the United States, they were necessary for China.
Well, the Chinese government is worrying all the capitalists in the world way more than it used to. And of course we don't like that. And we wish that China and the United States got along better. And if you stop to think about it, think of how massively stupid both China and the United States have been to allow the existing tensions to arise. What bad is ever going to happen to China or the United States if we two are close? If we make good friends out of the Chinese and vice versa, who in the hell is ever going to bother us? Of course we should make friends with China. And of course we should learn to get along with people who have a different system of government. We like our government because we're used to it and it has advantages of personal freedom. China could never have handled its life with a government like ours. They wouldn't be in the position they're in. They had to prevent 500 million or 600 million people from being born in China. They just measured the women's menstrual periods when they came to work and aborted those who weren't allowed to have children. You can't do that in the United States, and it really needed doing in China. And so they did what they had to do using their methods. And I don't think we should be criticizing China, which has terrible problems because they're not just like the United States. They do some things better than we do. They should like us and we should like them. So I think nothing is crazier than people who foment resentments on either side of that one.
Many famous investors like Munger have continued to invest in China. Monish Pabrai and Ray Dalio, Sequoia Capital, and venture capital powerhouse are some of them. Munger believes that the two countries, the United States and China, would maintain stable ties with reasonable honor, reducing the risk. Munger's presentation serves as a background for his ideas. Rising inflation, Fed tightening, supply chain difficulties, overvalued valuations, and speculation have put the markets in a perilous place. Munger's portfolio has managed to survive these macroeconomic developments by allocating funds to strong companies. His portfolio comprises mostly 5 companies: Bank of America, Wells Fargo, Alibaba, US Bank, and POSCO, a South Korean firm. Munger does not believe in diversification, hence he has chosen these 5 companies as his long-term champions. And that's it. You can share your thoughts by commenting on the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.